All right. Today I want to go over Chapter 8, in part at least. We're not going to cover in this lecture very much, mainly going to focus on bank reconciliation. Chapter 8 is one of those chapters that you need to read. I don't emphasize chapter reading too much, but in this one you need to. The first section of the chapter covers internal controls over assets, primarily over cash. And cash, of course, is the area where most fraud takes place. Excuse me, I'm trying to swallow here. So read the section on internal controls. You will be asked questions about that on the test. That also relates to the project you'll be doing after this chapter is over on SOX, which is the Sarbanes-Oxley Act. I want you to research that and figure out why the act came about, and what was the reason that it had to be done at all, and how it impacts companies, and then that will give you a little better idea how important internal controls have become in corporations. So I'll leave you to read that. What I want to go over with you, we're not going to cover petty cash funds. I will just tell you in a nutshell, a petty cash fund is when a company takes $100 cash and puts it in a box in the secretary's drawer, and then when she asks you to run out and buy stamps, she'll give you a $10 bill. You go get the stamps and bring a receipt back, and the change, it goes back in the box. And when it gets empty, you start to replenish it. So I just don't think that it's important that we belabor that. So we're going to go right on to checking accounts and check reconciliations. Let's see. It looks like I'm not sharing. I had hoped that I was sharing. Bear with me just 1 minute. Let me see if I can get this to come up like it should. Okay, now it's working. Okay, you can read a little bit about bank reconciliations, but you know most of this stuff. Everybody's pretty much had a checking account at this point in their lives. What I want to cover is how you reconcile the bank statement to the company's books. And here's an example that's in your book. I'm not sure what page it's on, maybe 323, something like that. Let's see the page number. Yeah, 323. This is the way you do a formal bank reconciliation, probably not like anything you've ever done on your own. You have to work with the bank balance and the ledger balance, both, to come up with a number for both of those that are equal. You don't start with the bank and end up with the book balance like the way I always did my personal account. So what you're going to do in a bank reconciliation is pick up the balance on the bank statement, pick up the balance from your books, from your general ledger cash account. These two are pretty much never going to be identical because of timing issues, if nothing else. The bank reconciliation, the bank part of the reconciliation is usually the easiest part to do. So I'd suggest you try to do that part first and get this number. Then when you start down here, you'll know what you're working towards. So first of all, for the bank, what we do on the bank side, just for the purpose of reconciliation, is we put in there things that we know that we've put in our books that the bank doesn't know about. So in this case, we have entered a deposit on our books that hasn't hit the bank yet. It got put in the bank after the statement was dropped or whatever. It's called a deposit in transit. The bank hasn't seen it yet, so let's just add it to their balance as if they knew about it, because it's already in our books. Likewise, we've written some checks that we've subtracted from our books, but the bank hasn't seen them yet. They haven't cleared. So let's take those out of the bank's balance as if they had cleared. And then after doing both of those things, we should have an adjusted bank balance that should be in line with our balance. The only other thing you can have happen up here is sometimes the bank will make an error. And if a bank makes an error, then you're going to have to adjust this balance up or down depending on what the error is. But the reason I say this is usually easier to find, this balance, get that, and then down here, it'll help you to get to the right number. You might have put something in that should have been added, was subtracted, so it'll help you to identify those kinds of errors. On the book part of the reconciliation, up here I said we add to the bank statement things that we know that they don't know. Down here, we add things that the bank knows that we didn't know until we got the bank statement. In this case, the bank collected money from one of our customers. Some companies do that, which included interest. So we didn't know that until we got our checking account. We're adding that in. We had a check that bounced. A company gave us a check for $102 in payment on their receivable, and the bank said, check's no good. So we had added that check into our deposit. Now we have to take it back out. And then these are a couple of fees from the bank, $15, $8. Again, we don't know that until we get the bank statement. So all of these things have to be subtracted out. And when we do that, we come up and we're in balance with the bank. Now, let me back up 1 minute because they don't cover it here. One of the reasons for doing it this way is it's very clear to understand, first of all, but secondly, everything down here on the bank side of the bank reconciliation has to be put on the books in terms of a journal entry. If you don't go in and make these corrections, next time you balance your checking account, you're going to be off by those numbers again, and you'll never find it. It'll be a nightmare. So what you have to do is make journal entries to put these things on the book. Now, one thing I don't like about this book is they do it in one big journal entry. I'd suggest you do them individually. For example, here you know this is cash coming in, so debit cash, credit note receivable, because this is obviously money someone is paying you. So you would be debiting cash for $1,225, credit note receivable for $1,000, and credit interest revenue for $25. Down here on the NSF, of course, you're taking money back out of the checking account, so it's a credit to cash. Debit accounts receivable. We had taken that receivable off the books when we initially got the check. Now we have to put it back on because he owes us that money again. The two service charges, I would just debit miscellaneous expense for those and credit cash for the $23. I wouldn't break those out. So it's a lot easier to do it in separate entries rather than one big entry like they show you in the book. You can do it either way you choose. But again, everything down here has to be put on the books in the form of a journal entry. Here they give you the very things that I just talked through, and they did do them one at a time, but I noticed in the problem solutions that I'm going to go over that they lump them all into one big entry. I prefer that you do it this way. I think it makes more sense, and I just think you'll understand it better that way. Again, there's not much for me to talk about here because in the problem illustrations, I'll be able to go through more examples of what can go wrong. So I'm just going to stop this lecture and go right into the problem solving. So I hope that this will help you just a little bit. But I think that the problem demos in this case is going to be what's going to be most relevant for you.